Hey, good evening, Brad.
What's going on, James? How are you?
All right. Welcome to Sunday Nights.
It is, yeah. So let me see here. Just checking the audio. Hey, everybody. Thanks for joining us this evening. It's been a couple days since we've had a live stream. Feel free to just, as always, go ahead and ask questions. We'll answer them. And with that, we'll get started.
Yeah, I was thinking starting off with one of the questions we had from the November 28th video about expectations for leg twos might be interesting.
Yeah, well, let's talk about that.
So the comment is actually in three parts. Well, a three-part comment. So first part was if I'm aiming for a second leg, where can I set a target with fair risk to reward each time? So actually, why don't I just pose the three different parts of the question, and then we can deal with them. If I buy, and then the second part is if I buy a pullback at 30%, and again at 70%, how often will the market not let you out break even on the trade? And then the third is, are there places past 70% to continue scaling in? So I mean, I think partly the larger conversation this is a part of would be the calibrated expectations and really understanding the nuances of the setup that you're trading, so that management, is aligned with what to be true of general performance. But it might be useful for me to share my screen and talk about the I1R as a setup.
Yeah, I completely agree. And one thing, trying to fix my sound really quick on this computer. One thing I would say that maybe we should talk about for a second, or maybe we can talk about it afterwards, is the general expectation after you get a breakout. So when I heard that question, and James, you correct me if I'm misunderstanding the question.
Mhm.
You have a breakout. The question is, how far of a move can you expect given the pullback, right?
Mm-hmm.
And I'm wondering, we should show some examples. I'm wondering if we could take a second to draw up just a few examples of when you get a breakout, what happens when it pulls back 20% or 30% in general,
Mhm.
versus what happens when it pulls back 50%. In other words, the more the market's in a trading range, the more the market's going to pull back. The reason, because it's testing breakout points. And obviously, the more it's trending, the less the pullback, because traders are buying momentum. And that's a really, and James, I think you should still definitely share your screen. And maybe we can, James, maybe can you find a couple of examples on your computer of pullbacks that were maybe 20% versus pullbacks that were deeper, 50%?
I mean, we have some great examples on Friday.
Yeah, let me share your screen. Yeah, so we can see your screen.
So here, here's a good example. So end of day, Thursday into Friday. This was a bull, bull I1R that got a 30% pullback, and then this bear structure here generated an I1R on the open. And so this bear I1R actually got a pullback that never closed above the swing point that generated the setup, but definitely confirmed that we're in a trading range, right? The pullback that deep from this setup structure suggests trading range behavior. So then we get two legs down with about 30% pullback there, and when you get a pullback this deep, the implication is that because you're in a trading range, you should expect, two leg moves across the trading range. And you don't know that you're going to be in a trading range until you get the second leg that fails to close above that setup, and then you can expect two more legs down. But the interesting thing is here, when the market begins to change and you get another I1R that stops generating here on bar 21 and then gets the first bear bar, adverse bar, and then entry, the optimal entry here at 30% pullback. When an I1R setup, which is just one way of assessing breakouts, it's a breakout and a specific type of reversal, but entry at 30% here gets you back to the swing high. But I guess the question is here, whether your expectation can be more than just returning to the swing high.
And James, for real quick, just to so we can explain this to the audience. That bar you have pointed over, bar 21.
Yeah.
Let's talk about for a second. Tell us why the logic of if I'm a bull, if bar 21 is that big bull bar, and I'm a bull and I bought the close of that bar, why is it that we can expect, what is it that we can expect if the market pulled back to where it did, basically the 23 low? What's the logic of those traders going to do if they bought the close of 21 and they maybe bought more lower? If they bought the close of 21 and they bought more lower during 22 or 23, what's going to be their general expectation?
Return to the previous swing point. And that's generally what my research showed is under most scenarios, the optimal exit, as long as you're willing to re-enter on later setups. Like if you're trading pullbacks for swing trades to hold over longer durations, your holding time and your setup selection might be slightly different than what I'm looking at here, because
certainly
this setup is really a 2 to 3 bar trade under normal conditions. And so here, the pullback, and so one of the things that I found in researching the I1R setup is actually that when you have an I1R setup that lasts for more than 4 bars, so this one is 1, 2, 3, 4, 5, 6, 7, 8 bars, bar 15 to bar, 7 bars, 15 to 21. It typically pulls back less because it suggests this is control over price and time versus just a big bar, which is really control over price. And so when one side of the market has control over both price and time over a longer period, then the pullback is typically shallower, and there is a higher probability for some kind of measured move. And in that case, what I usually do. Looking at this one. So it's from the signal bar low, not the, and is this particular setup. You could do this differently, but for this particular setup, you're measuring from the signal bar to where the setup ends, and then down to the pullback location. So that would be the 1-to-1 measured move. The reason you don't measure from, okay. So the reason you don't measure from the low of this bar is because this does not become the new signal bar from which you are measuring. So the signal bar that determines the I1R targets and the I1R expectations is the point, the signal bar on which the market had the reversal that generated the potential to reach an I1R target. And that's basically if the market reaches a measured move of this signal bar without getting any bars in the other direction. So all of these are bull bars until you get to bar 20, at which point the I1R confirms. And then you go beyond that, obviously, with this big breakout bar. So that pullback from that, the expectation is, because it is a control over price and time, around a 30 to 50% pullback with some kind of measured move. It doesn't have to be a full 1-to-1, but it can be. Sorry, let me do this measure move again. This is looking funky. So here, yeah. There we go. That looks better. Okay. Yes. Okay. So there's your 50%. We got some initial selling at the 50, pulled back, and then here, and then when you got the pullback to this point where folks were fading or getting out of positions, then and it got the breakout beyond there, it became support on the second test here. So there are a number of different things that happen once you can calibrate expectations and you really understand the setup. You can extend those expectations to subsequent price action that develops as a result of what happens beyond just the setup and beyond your normal expectations for the trade. Like, for example, if you're going to take this trade and look for a 50% extension, which is obviously a higher probability than getting a full 1-to-1, the 50% extension would be you could take full profits there. But then when this bar 27 gets a significant breakout above there, you could buy again at that level, knowing that the people who were selling there, expecting only that much of a breakout, are trapped, and they're going to get out, and the market will continue in the direction of that breakout. So this is to say that there are a lot of different expectations that you can calibrate once you've studied the setup for your breakout, and that will be determining the your expectations for pullback and measured moves. But it's really particular to the type of setup. Like if it's just a breakout and follow through, you're only looking at a 2-bar setup. And so the way that you handle those pullbacks and the expectations for measured moves will be different than it is for like an I1R setup, which is a different kind of leg 1, leg 2 setup.
Makes perfect sense. And James, that might be a good quick transition into this person's question. What's the most challenging part about completing SA2? Which SA2, for those that obviously most people know, SA2 is Systems Academy 2 for it's an acronym. But James, what would you say the most, out of everything, what would you say is the most challenging part? And maybe a better question would be, and this is a good question, maybe we can talk about, we can tie in. We're starting the process of, Systems Academy and everything right now. What do you see as that's going to be the most challenging, now that we're on the other side of this, what do you see that's going to be the most challenging aspect of Systems Academy for everybody? Is there one specific?
I mean, I think it's the, to use the extend the metaphor, control over time, just like continuing to do the work every day, because there is work to do every
So just kind of the grueling leg work.
And there's a lot of it. I mean, determining which setup you initially want to research, doing all the research, and then going back through all the iterations of that to determine how you want to begin thinking about fitting this into a system design or the design of a system. And so I think initially the most challenging part is orienting yourself in the program and understanding the trajectory and the expectations for each of those steps along it, and then where your sense of being a trader fits in that. So when you're getting into the statistics section or into the goals, do you have a sense of the goals that you can put together for a year, 5 years, 10 years? If you haven't really thought that far in advance, some people have, some people haven't. And so if you haven't considered all of those things 10 years down the line, then it might be a longer process for that section. It might be an easier process in the statistics section if you were a stat major in college. So there's definitely different places where other certain people will feel more of the effort. But I think in general, because there's so many different parts, the most, I don't want to say it's challenging, the most important thing is taking them in the proper order. Because if you start jumping around and trying to like get things done that don't need to happen, then it's easy to get distracted and not take care of the more foundational things that will, like, understanding all of the parts of a system, so that when you start developing it, you don't move on to looking at targets and kind of the later stages of system design, versus looking at the things that make you feel best as a trader, which is really where you should start.
You kind of, I definitely agree with you on the second piece. And you're right. Everyone's going to have certain strengths and weaknesses in different pieces of Systems Academy. As you said, if you're heavy in the math, you're going to understand the stats much faster than others. Others are going to be more methodical. But one thing that I love what you said, and I was going to bring it up, is it's natural for, when we see it right now, it's natural for people to want to try and skip steps and to think that they, for example, defining your objectives. What are your trading goals? And that seems like a very simple one sentence answer, but it's really not a one sentence answer. And we see it where people want to, they're like, oh yeah, I know what my goals are. That's easy. I don't need to deal with it. I'm going to move straight towards building my system. And then they end up building a system that doesn't quite meet their goals or their lifestyle, or they didn't think there was something they didn't plan through.
Or they jump in and, like, someone who didn't have experience coding, like you've talked about this,
Sure.
like you didn't have any experience coding, and you're like, well, I just need to jump in and start coding. You're like,
Yeah, it's a bad idea.
like, this is not what I need to be doing now. And like, and it takes a few
Absolutely.
minutes before you step back and you're like, this just doesn't make any sense. Like, this can't be where I need to put my effort now. And yeah, I mean, it's I think, and that place will be different for every person, because the preparedness of each kind of component might be different for each person. But I think the
100,
really important thing
100%.
is really going through all of the video material that Ali has put together, and becoming familiar with it enough that there's no uncertainty about expectations, and because that allows everyone to remain oriented where their efforts need to be at any time. Like after 2 or 3 months, students should have a pretty good sense of where they want to start their research. It shouldn't be like a mystery at that point.
And and it's funny because 2 or 3 months seems like that's a long time. Like that seems like, oh, I'm wasting if I'm not looking at a chart or building my system, I'm wasting my time. And it's really not true, because the planning that goes into, as you kind of hinted at, the preparation that goes into actually knowing what you're going to research and design goes way before you look at charts. And we're all guilty. We were all guilty at it in the beginning, and we see students right now doing it, and some of them, and that is, it's very easy to want to think through, I need to code or I need to do this, when really, and you said it in the last class, focus on, what do you know right now? What do you know that's true, that you understand reasonably well? Start with that idea. After you go through your goals, after you've watched the video course. And people have the wrong idea. They think, oh, it's 30 hours of videos. That's not that long. I'll just watch it real quick over a weekend and I'm done. And that's not true either, because there's a lot of information in it.
Yeah, I mean,
But
I think that.
I would go ahead.
No, you finish. Sorry,
Yeah,
I
I
know
was
you're done.
just going to say, I firmly believe, though, and we've seen it. There's I can see it. There's in several of the students we have now, the ones that are very just, they listen towards, okay, step 1, watch all the videos, check the box. Step 2, rewatch the videos, take notes on the videos, check that box. Step 3, go to the objectives. They've already watched it 2 or 3 times and really start beginning that process of writing the objectives. The ones that are doing that, they have a lot more clarity as to what they're trying to do in the first place. And
Yeah, I mean, I think that's a good point, and I think that because this is a program for intermediate advanced traders, I think a I don't say it's a misconception, but a common unhelpful approach, maybe that maybe misconception is the best word, is that you can just jump right in and start using what you know already to develop a system. And that's true in part. Like, I have there are students who've sent me some really interesting code, who are working on, who know what they want to research for their first ideas, and I mean that's all really great. And I know that they're going to be successful in their first passes because they've put so much thought into it. I think that the fallacy is that that's the starting point, right? And to be fair, those students have already gone through all the material, right? So they understand what the expectation is. I
100%.
think that, like, for someone who is just like considering SA2, and we should also make it clear that there is a rolling admission to SA2, so like anyone can sign up, at this point and participate, and there's no barrier to entry beyond just the interview and all of the normal uh, admission processes. However,
But there's a certain place people need to be at.
right. I mean, the normal admission processes are still in place, but I mean, as far as like timing, we've started, but there will be a rolling admission, over the coming months, and the the students who've gone through all of that material and who've started submitting stuff to me, like questions, snippets of code, ideas for first system research. I they've In their work, I can see that they understand the trajectory, right, and what they are working towards in their first iterations of their system. And I think that the challenge is in maintaining that larger picture while you're working on these really small modules that all come together, you know, uh, to make the system. Because it's so easy for one of those to pull you in another direction and start a whole nother research project as a result of like finding something interesting. I mean,
100%.
I'm guilty of it. I did a market study on gaps in the middle of my research on I1Rs because I was noticing that gaps on the open would create I1Rs, like we just looked at on the screen, when I was sharing my screen. And I was like, well, how do we treat these? Like, are these the same as other I1R setups? And like, how do I calibrate the expectations for these? So I ended up doing a gap study, and I don't know that that was necessarily the most useful thing. I could have just skipped the gap study and just not traded I1Rs that form on the open for a while and come back and done that later instead of spending a bunch of time doing it in the middle of SA2.
Makes perfect sense. And it's easy to, as you were just saying, it's so easy to lose the end goal, what you're building. And you see the shiny whatever on this side. So you run over there and you're looking at either breakouts, then someone switches to something completely different. And that's the one thing I would say out of anything that really throws people off. It's one thing to study something, but to really advise whatever you're trying to build, finish it through. Unless you conclude that there's no way that it's going to meet your personality, it's really advised to stick through it, because it's easy, as as you mentioned, when you're studying it, it gets kind of grueling and monotonous, and it can be easy and to want to switch halfway through, and then you end up never building a system.
Yeah, yeah, and we did see some of the folks who didn't finish SA2 in last year. I don't know the particulars of their there's myriad things that they could have led to that. But one of the things that, as an outsider, someone observing the process, I can comment on is just that at some point I just stopped hearing from them.
So yeah,
the
they stopped showing up. That's a great point.
the folks who remained engaged with the community, the class, were, I mean, obviously they all finished the program. They all have systems that they've developed. And many of them have returned as SA2 students for this year and are continuing to participate. Just because they found it so meaningful and the community so engaged. And I think that's one of the, if you can really lean into it, that's one of the things that will help with any of those challenging periods, is to just, reflect your experience of that portion of the program with the other students, say in the Telegram group or during the coaching sessions, because everyone is going through the same thing. I mean, it's like a boot camp, a little bit of a gentler boot camp. And yeah, I think that the fact that everyone is going through it at the same time helps a lot when you do run into those difficult parts.
Oh, absolutely. And it's interesting. Obviously, one of the reasons those people are wanting to either, in the way Systems Academy works, is it's a year-long program, but those that would like to continue, they have the ability to continue and kind of roll into the next class. And we've got at least four at least,
Yeah,
maybe more than
at a fraction of the cost too. So like you can
yeah.
continue.
It's a
Yeah,
most of them I think they're doing. It's significantly discounted, but the reason they're obviously doing it is because they understand they've built a few systems, they're confident they work, and then it's just rolling into either further improving the system or building different pieces of a system, so something new, or maybe
yeah,
it's refining. But they're understanding that if they want to truly become a discretionary trader, it starts with that one system. It turns into two. So it starts the breakout system or a trending system, and then a trading range system, which others call an anti-trend system. And then it starts building, a system for fading a high one, buying below a low one, selling above a high one, or entering on a stop entry, or at the top of a trading range. What do you do if the market starts to break to the downside? Do you sell? Do you sell as it's going down? Do you sell a pullback? So there's so many different ways you can trade. And once you start learning systems behind it, the other thing, stop it. Your protective stop can be, you can use the same stop method for a lot of systems. Wouldn't you say, James?
yeah. I mean,
It's not like a
all of
brand new thing you have to fully, understand to a degree.
yeah. I mean, once you have the different modules for your systems, many of them are they're not like hot swappable, but they're modifiable and reusable. Like,
Exactly.
all of your stops are going to be based typically on either one or a multi-bar signal. And so, like for example, the I1R stop is a measured move, below the signal bar. It's a generous stop that allows you uh, some flexibility. Whereas like a breakout and follow through stop is typically, depending on the size of the bars, either a measured move of both of those bars, or if one of them is a very large bar, a measured move of just a large bar. So like, it depends on the nuances of the setup, but it's always like once you understand the logic for determining that stop and how it's related to the setup and the signal, then it's transferable across all of the systems.
No, absolutely it is. And let's see, we have one. I'm looking through the questions real quick. And again, feel free to ask questions
This one's
for those of
good.
you that have some.
Can you give some detail about scaling and scaling out?
What do you think, James?
Um, I don't really scale out. I'm usually full out because I'm looking
Yeah,
for
okay.
like one or
Then
two bars. I don't usually swing a position, even on days when I probably should. I just take multiple entries. So maybe that's something
sure,
I should work on. But
yeah,
maybe that's something you should comment on then if
yeah,
you
I'll
hear
comment on.
more.
So I like to, I generally scale in and scale out pretty regularly. Let me pull up. Let me just share a chart. Let me just pull up a chart. We'll talk about
Yeah,
it.
I scale in, but my scale out is full out.
So let me do this. Give me 1 second here.
on the 28th. The example that DJ kind of gives is on the 28th, actually. So I'm just going over to there.
Yeah, I'll go over to the 28th right now.
Say
So
bar 13 to 15. I can, before you get into the because this is definitely a good question for you and the scaling out. I would say that because that is an I1R setup and it gets to the 50% pullback, I would be out fully at the high of bar 15.
And this is for the 28th, right?
Yeah.
I'm going to turn on the bar counter just to make it easy for everybody. So give it 2 seconds here.
Yeah, so that setup in particular, you asked about the I1R, and I think because the I1R has a number of nuances about trade management, kind of embedded in it. When you get a 30% pullback, uh, there is a bit more flexibility for scaling out because there's a higher probability of measured moves, whereas a 50% pullback has a much higher probability of marginal breakout beyond uh, the swing high prior to the pullback. So,
which makes perfect sense. And one of the things I would say if we're looking at, for example, this person's asking, this is the question overall. Can you give some detail on scaling in, scaling out process? For example, bars, this area 13 through right here. And generally speaking, whenever I'm scaling in or scaling out, let's start with scaling in. Most traders, I'm going to stick to what Al always says. Most traders should focus on scaling into a winning trade, not scaling into a losing trade. And there's an obvious reason for that. When you start scaling in, you start to realize that, eventually traders, they end up, let's say, buying up here, buying more down here, and they start realizing, hey, I can get out break even. But what happens is ultimately, because they won't understand how to exit, they'll buy here, they'll buy here, they'll buy here, they'll buy here, and they'll just take a massive loss here. Most traders should focus on my general method of scaling in. I like to see a strong breakout that's generally something like leg one. In other words, it's a strong enough to either flips the markets always in long. It resets the market cycle. So as James talked about in the past, the first principles analogy, it's a breakout that's going to get a second leg. And a lot of traders, what they do here, this is a big bar, 15. Some traders will buy the close and buy more lower. Other traders, they don't like to buy big bars, especially at the top of the trading range. So they'll buy on limit order. Generally speaking, when I look at a trade, so the first thing I always want to do whenever I'm scaling in or trading in general, you want to trade small. And when I go to this right here, the one thing we know for sure, 100%, this is a trading range. It might become a bull trend, but it's a trading range. So if I'm buying, the one thing I don't want to do is put a stop below 15, because what do I expect to be below 15? There's probably buyers. So if I'm buying here, there's really two ways I'm going to manage the trade. I'm going to exit early, either below a bear bar, and then look to buy again lower, or I'm going to trade really small and use the stop somewhere down here. Now, the reason for the stop down here is just it's far enough out of the way so I can scale in. This is not the greatest place. A lot of traders, if they bought here, do you see why this tail it's 17 right here? Do you see why the tail went to the 50% level? Bulls bought here. They bought a pullback. It basically let them out almost break even. But a lot of traders, what they end up doing is this. They buy this close. They're disappointed. They scale in lower. And the reason why this bar pulled back a little bit is those traders ended up selling. This example here is a lot of trading range price action. But if you remember what James talked about earlier, traders buy the close of something. They pay attention to what their actual risk was on the trade. They buy here. This is 1 times the risk. And no surprise, the market went to at least 1 times the trader's actual risk. And really, as far as scaling in, let me find a different example. Here's a good example. So whenever I see something like this, 2 legs up, and I see a big bear bar and then a big follow-through bar, it's a breakout with follow-through. Chances are it's going lower. I'm willing to sell the close and continue to sell lower, especially when I think there's going to be a second leg. So basically when the market's in leg 1. So anywhere here, the reason traders will sell here is because they know the first reversal up will fail. So if you sell the close, you get another bear bar. It's not great, but it's not a bull bar. Traders are still going to sell and sell higher. They'll sell this bar. They'll sell this bar. Here, you're starting to get tails. So traders start to lighten their position, looking to sell higher. But the reality is, the reason why traders will sell as it's going lower is this right here. What's the probability the market's going to go down here before it goes up to the bar 6 high? It's probably going to go sideways more, but the chances are we're going to go somewhere down here before you go all the way up here, at least on the first reversal attempt. And that's generally how I see scaling in. My favorite trade, and James, feel free to chime in at any point. My favorite style of trading is trading breakouts. A lot of times I'll sometimes buy bar 1 and maybe buy bar 2, but whenever I see something like bar 2 on the open, I generally go flat because it's not what I want. I'm hoping bar 1's a bull bar and bar 2's a bigger bull bar. When I see something like this, I'm happy to sell and scale in. And let's say I sold and scaled in to the position, and now the market's going sideways. Sometimes it's more than okay. A lot of traders, if they sell every close and they start scaling into a winning trade, they have a big risk. Since they have a big risk, what do they have to do? They've got to take profits. So when the market starts to go sideways, that's exactly what they do. But a lot of traders, they're going to hold on to at least a partial position because they know one thing's likely. This right here. Now, for me, last thing I want to say about scaling in, this is a different situation. We have a rally to the open of the day. And at this point, this is actually not the open of the day. I think it's open of the week. In any regard, if you're long up here, I'm not scaling in below 67. Now, why would I not scale in below 67? The reason is fairly simple. If I'm buying up here, I have 2 choices for stop placement. I can get out below a bit, in general, one of my stops and one of, Ali's, a lot of people's stops. And I'm sure, James, you have something similar. A lot of traders get out below a bear bar closing on their low, especially when it's in a trading range. Here, I would either get out of longs, so I would not scale in. The reason why I wouldn't scale in is because the buy zone is somewhere down here. So I don't want to sell. I don't want to buy here and then have a stop somewhere here. If I'm going to buy and buy all the way down here, guess where the stop goes? It does not go right here. You would think, oh, that's the bottom of the rally, or maybe bar 53 is the bottom of the rally. That's not true. That's the bottom of a trading range. So the reality is, if you're buying and scaling in all the way down, you need to stop somewhere down here. If you got to listen to Al on Friday, Al said that this bar right here is a bull breakout, and you could buy the close of the bar. It's an outside up bar. It's not a great buy. But if you did buy it, the one thing Al said was he would get out quickly somewhere here and take a small loss, or he would use a really wide stop, a measured move down of the bar. Now, why is that? Because it's a trading range. So now, let's tie this back to a discussion, James. Let me move this chart out of the way. There we go.
Well, actually, could you bring the chart back up for 1 second? Because I think there was an interesting point where you were talking about the probability for the pullback between bars 12 and 18.
What day?
It was on the 29th. So you said, some traders will hold their position, a portion of their position, because they know the second leg down is likely,
Sure.
because obviously what you've had up until that point is not anywhere close to equivalent enough for the market to have any kind of symmetry. And obviously, it's possible that that could fail and you could get a big reversal, but that's very low probability. The higher probability event is a pullback for some kind of measured move down. Now, there are some traders who will hold a portion of their position to swing and maybe add a little bit more on the pullback. Um, and I think this is kind of gets back to a bit of the underlying reason why it's hard to trade systems that other people develop. Because for me, the I1R system that I developed would not tolerate that kind of pullback and that amount of time in the trade. It would actually undermine the performance of the system, because the one of the reasons for the system's high SQN is the general continuity or consistency of number of R that the setup that the system produces from each trade, and the number of bars that it exposes you to. And so one of the things that I prefer as a scalper is to have very little exposure to time. And so I don't want to be in trades for more than 2 or 3 bars. So while I can logically see the reason for holding and perhaps adding to the position, for me, I know that that would make me feel uncomfortable. So I've designed systems that you know, do not account for trade management that way. Whereas other people would definitely develop that. And Brad, I mean, I'm sure that you've
James,
either
you just
traded
went
that way
down a
before.
rabbit hole, and we got to talk about it now.
Yeah, sure, sure.
So, yeah, no,
Yeah.
this is a wonderful conversation. Someone asked, "What is SQN?" James, do you want to explain SQN for a quick second?
Sure. Well, why don't we finish this up and then we can get into SQN, because that's a bit much as well.
Well, yeah, okay. So let me back up. I didn't mean to get distracted there. I saw the question. SQN is system quality number, but the one thing James just said, and that's a really, really valuable point. James said he has a high system quality. He has a high SQN because of his time in the market. A very efficient system is going to be in and out as quick as possible, because the longer you're in the market, the greater the risk or exposure to something happening. You cannot have, and this is the great example of why Al says a swing trading system cannot have extremely high probability. If you want to, when Al talks about these trades that are 80% probability or those really high numbers, and it seems, people ask all the time, well, how do you see them? And Al says it's very subjective and it's not very clear. And it's usually a very fast situation. And what James is ultimately saying is somewhere in here, when this market is free, when it's selling off rather quickly, there's a very high probability of lower prices. But at some point down here, that changes. One of the single, I see this question all the time from people, and one of the biggest challenges people face. And while I'm talking, let me fix one thing on my computer while I'm explaining this. One of the biggest things people face is everybody knows they want to be a high probability trader. They want to trade like James, as he just mentioned, and they want to have a high Z score, as Al's called it in the trading course, or system quality number, SQN, in this example. They want to have a high probability because the risk of ruin goes down. And if you can have a high probability system, you're going to win most of the time. And that's a lot more fun than having a losing trade most of the time. But what they don't realize is when you have a high probability system or a trade, for example, let's find an example. Let's say let me talk about 17 for a second. You look at 17, or better yet, you look at bar 17, and you look at that bar and you think that's a terrible stop entry buy. And it is. The context is poor for the buy. But when you think about it, 17 is a big bull bar closing on its high. Do you think on the close of 17, on the open of the next bar, do you think 18 went up in 1 second and then just straight down and hovered down here until it closed? Of course not. The reality is what 18 did is 18 opened and it went sideways. So I'm willing to bet if, James, we went to market replay, we could pull up this bar, and this bar did not form in 1 second. What probably happened is if I bought the close of 17, 18 just went sideways. It did not race up. So think about it. If you sold the close of bar 7, what did 8 do? It went up a couple of ticks and went straight down. That's a strong breakout. But when the market's going sideways and there's not a lot of momentum, then you lose the factor of probability. The number one thing that screws traders up all the time is this right here. They buy a breakout and they think and this is not a great example, it's 3 legs up, but they buy a bar and they think to themselves, high probability of the market going higher. And that might be true. But what they end up doing is they hold on to the trade. So they say, okay, bull breakout bar 25. Al says put your stop below. I'm going to put my stop below the bar. And they have a one-to-one risk reward. And what ends up happening is they just hold on to the trade and they end up getting stopped out. So James, I have a question for you. You said you like to take, my mouse is freaking out. For your system, you prefer to be in and out of the market, right?
Yeah, and actually, the system that I'm currently trading is really even faster than the I1R. It generates a lot more setups, and so I eventually developed that one because, and actually, it's downstream of the thing that the trend and trading range histogram that I put together as kind of the starting point for these kinds of conversations. When you and I were talking about doing this, I was like, well, it might be nice to just give an example of the kind of thing you can code for with price action. It's just determining whether a bar is a trend or a trading range bar, like a very simple thing and pretty foundational for determining what kind of system you would want to deploy. That ended up being a lot more useful than I thought, and so I developed a number of things to use with it. So that's been really interesting, and it is typically in and out of the market in 1 or 2 bars.
1 or 2 bars.
Yeah.
And the reason I mentioned that is how often, I'm going to take us back for a second, just you and I really quick. How often, in generalities, you like to be in and out in 1 to 2, 1 to 3 bars? What's your time? How long are you going to hang on to the trade? So in other words, is there ever a situation where you're going to be in the trade for 15 bars?
No.
Why?
Because it will. I mean, my research will. That would be a totally different system. So
you broke the system, right?
Yeah, I mean the system. If I have 2 adverse closes against the position, then the trade has failed. Statistically, I think less than 5% of the trades remain profitable after 2 adverse closes, versus the number of trades that actually hit the expected target after 3 bars is extremely low. So typically it actually hits the target within 1 to 2 bars. And so
did everyone just hear what James just said? You cannot have a system. If your system is in and out in 1 to 3 bars, you cannot hang on to the trade for 12 or 13 or 14 bars. It doesn't, you can't have the high probability system where you get the luxury of holding on forever. So James has to be quick to get in and quick to get out. And if he does that, he's rewarded with an entry and a quick exit.
Which also means that I'm not in big moves. I'm not sitting like, a lot of the traders who watch, YouTube videos of people like who put a chart up on the screen and say, I was in this big move and this like this big parabolic advance, either up or down or whatever. And I'm not in this. Like,
and
I rarely trade those because if I'm, trading individual bars within them, I might hold for 2, 3 bars. But I mean, those epic moves in crude oil or huge moves in Tesla, it's like I would never. My system would not have me sitting in those moves.
Mm-hmm. And that's why a lot of traders naturally, think about. I've talked a lot about always in, so I'm going to use that as a reference. And if you listen to Al, he talks a lot about that. When he started trading more in the beginning, he traded a lot with stop entries. It was basically trading his version of failed breakouts and always in. So sell second entry short at the top of yesterday's high, hold for 2 legs down, and he would end up at one point. He would talk about how he would reverse back and forth. But naturally, what traders end up doing is they start swing trading, and this is at least one path. They'll swing trade, but then they start to realize there's all these little trades. So what James is mentioning with some of his systems is he understands that the reason he doesn't want to swing trade is because he understands most of the time you're losing open profit, or it's not as fun. It's not as relaxing because the market's mostly going sideways, you're not going to catch the big move down for the big second leg. Most of the time, the market's going to go up for a couple of bars, pull back, go down for a couple of bars, and go sideways. But back to James and his I1R system, all of that is explained, and he understands all of that because he put in the research and the time to understand it. So someone asked a question. I'm going to pull it up here.
While you're pulling that up, one of the other things that's really helpful to think about is how much open profit you're comfortable letting go of, and what kind of size you're willing to trade. Because if we know that the market typically does not have an unbroken move of beyond 4 to 6 bars, typically 3 to 4 bars is what you'll get directionally before some kind of pullback, whether it's a 1 bar pullback making a higher high in a bear trend or a lower low in a bull trend to start the channel phase of the market cycle. Those moves don't extend that long. And so the idea of holding for 15 bars, 20 bars presupposes that you're going to be holding through substantial pullbacks. And that has to be something that you are comfortable with, because any of those pullbacks can also become, trading ranges, and they can become full reversals. And so there are a lot of uncertainties that you expose yourself to by holding for longer periods of time. And so that's actually one of the other reasons is that's one of the reasons I like to reduce my exposure to time.
Makes perfect sense. And one of the things, I'll just show it really quick. The one things that James mentioned is he was talking about he wants to reduce exposure with time. A lot of traders, I'm the same way. A lot of people do this. When they start to see the range going sideways, like down here, they are less aggressive. They either don't trade it.
Can you share your screen? I think you're.
Oh, thank you. Okay. Thought it was. So a lot of traders, when they see the market going sideways, if I can drag, there we go. When they see the market going up and down like this, they get bored trading. And a lot of traders, there's plenty of traders that all they do is go back to this day we had over here. All they do is wait for little moments like this. And there's at least, you'll see a couple of quick breakouts every day. They don't always go this far down, but there's at least a few. And what traders naturally do, you hear I'll talk about it all the time. They'll sell maybe a small position up here. Whenever I'm taking a stop entry or a lower probability trade, I'm generally going to trade maybe 20% of a normal position size. And the reason is the getting in early is just a way to just get into the trade early. But my preference is I really want to see a strong move, because if I see a strong move, I know I've got a window of time where it's either going to go sideways, maybe pull back, and then I can get out near the bottom, or it's going to continue lower and give me a second leg. But either way, there's going to be some sort of second leg. So a lot of traders, they like to sell somewhat aggressively on the way down, and then exit either when you get a bull bar, get out around break even, or maybe near the last close. That's why a lot of low ones have buyers below. Traders, they sell every close. In theory, someone sells, they sell more here. Whether or not they take profits, they sell. They even sell this bar, even though it's not great. Then they get a bull bar, and then they get out break even. And then they wait as the market starts to go sideways. They wait again, bad high one, and then you get a breakout. And then traders, either they start selling somewhere in here. Other traders hold for the second leg. But the issue is, here's the biggest thing I think traders have to realize. If you're selling here and your stops one tick above bar 6, as Al says in the video course, it should be, That is more of the swing point. Al is never going to sell the close of this bar and put a stop one tick above bar 6, because the problem with that is what happens. I mean, James, since you can speak back, what happens if the market rallies up to the high of bar 6 over the next 12 bars, what's the market cycle probably going to be?
Trading range.
Trading range. So why would anyone buy up here at the top of the trading range? They wouldn't. So if no one would buy up here, you would of course not buy. You wouldn't sell out of long. You would not buy back shorts at the top of the trading range, and that's part of the reason why a lot of traders, when they're selling breakouts, they exit very quickly because they don't want to have a very wide stop. And there's several other reasons with risk reward, but
Well,
let's see here.
yeah, there's an interesting question here about how will your training help someone whose market isn't as fast as yours, and where you can clearly see tape and footprint and limit buyers and sellers, and
Yeah.
yeah, it brings up an interesting principle of system design, and which Ali really focuses on, and in which you have to define clearly for your system. Part of your system documentation accounts for your beliefs, right? Which might sound a little like esoteric, but it's important to articulate what you believe about how the market works, because all of the things that we're talking about now and that any trader talks about is just their belief. Like it's them superimposing what they think, the narrative that they believe to be true, and they're using it to tell the story that they believe to be unfolding. And evidence suggests that some of those are more accurate ways of actually telling the story of what's happening. But for me, I've never found the ability to tell a coherent story based on order flow, the tape, and depth of market. And I think it's for a variety of perfectly evidence backed reasons, like dark pools and iceberg, or like the inability to really account for the motive for people who are buying. It's like our big buys, actually people taking profit on massive shorts? Are they people who are, gamma hedging, their options positions? Are they, I mean, there's so many reasons why someone might be apparently buying for a directional position, and it has nothing to do with direction. And especially in something like the E-mini, where there's a robust options market, and you could have a lot of futures positioning that just reflects one of the Greek exposures without actually being a directional position, and that can really throw off the logic that you use for actually justifying what you see on the tape or in a footprint or whatever. You're muted. Sorry.
Thank you for that. That's a really well stated answer. And I agree with James says. We all have false beliefs. One of mine for the longest time was it was really hard for me to accept that I'm used to looking at a 5-minute chart, and it took me forever to be okay with looking at a 60-minute chart or a daily chart or a weekly chart. And what I realized is I was looking at a chart, whether it's a daily chart, a 240-minute chart of Forex. I was looking at it a long time ago, and I realized that I had this bias towards it where it doesn't operate the same way, because I would try and trade it and I couldn't trade it. And then I realized the reason why is because I had this false belief of the market's acting different when it's really not acting any different. What it is I'm not being patient. I'm responding based on my emotions and feelings of a 5-minute chart, whereas the trade should last an hour. Well, if I'm trading a 60-minute chart, that trade could last 6 hours. That would only be 6 bars. So what it really made me realize is every chart's the same. Part of my reason, I'm not a big fan of tick charts. I'm not a fan of volume charts. One of my problems with it is, and there's nothing wrong with them. My issue I have with it is I want to be able to look at any chart. If James told me to, look up whatever symbol on TradeStation, I want to be able to look at it on whatever that time frame is and read it. And for one, that keeps me believing that all markets respond the same. To what James said about, depth dome trading or all of those, plenty of people use it. I, for one, I have no idea how to read volume, or, I get that there's certain, climactic, certain bars have more volume, but what do I do with that information? So as part of, if I'm going to trade a system, whatever I'm absorbing, I want to be able to use it.
It's
And
like
it's very
trading
important.
news. It's like trading news, right?
Yeah. Well, I mean, I could,
Like how
well,
do
how
you
do I
account
use
for
it?
how do you account for the directionality of the news? Like did the market how does the market value that number?
Hmm.
It's very similar to volume. It's like, does the market feel that the volume on that bar, which is a big bar, is starting a new market cycle or it's climactic? I mean, context, and I think that's where your reading of price action would really
There was
be much more useful.
yeah, I wish I remember Malaysia flight. It was the Malaysian flight in, I think, 2014 that was
Hmm.
shot down by, they say it was Russia. Who knows? Someone, it got shot down by a rocket. And I'll never forget, I was watching out in the trading room that morning, and I was watching the mini, and the market formed a parabolic wedge. And this whole time, Al was talking from basically bar 6. Al kept saying it's a parabolic wedge top. If we start to get a micro channel down, be ready, because parabolic wedges on the open often lead to opening reversals. And this just happened to be the day. I'm sure, was the plane the catalyst that led to a big sell off in second leg? Who knows? But the chart formed a parabolic wedge on the open. It was a small range. It was hinting that the range, it was going to be some sort of opening reversal. And Al, if you for those of you that listen now in the trading room way, way back, and he may say it some now, but he used to always make a comment. Someone would ask, "Oh, did the news do this?" And Al would say, if a kid dropped his ice cream cone in India, is that gonna change the market? Is that gonna cause the market to go up or down? And the point is, there's so many different factors in news, you will get beyond analysis paralysis. So to answer this person, how will your training help someone whose market is fast as yours? Let's start with, how will your training help? The reason, really what Systems Academy accomplishes is it teaches you how to build a system, how to, how to learn to build a system that meets whatever your goals are, and more importantly, how to put in the actual work to learn whatever it is you're trying to understand. Like James, he's looked at I1R, everything about an I1R for I don't know how long, but he understands it really, really well. And he's very, that is something he's very, very confident with. And that, Systems Academy in a nutshell teaches you how to build a system that's going to match your personality. And there's all sorts of ways you can do that. But a chart is a chart at the end of the day. And James talking about I1Rs on any market that's a liquid market that's got reasonable volume, the I1R concept would work.
Yeah, and actually, I mean, the Al has I've heard him asked a dozen times why he doesn't have volume on his chart, and he said
It's
his answer
distracting.
and his answer is perfect. He's like, have you seen how much volume is traded every day? Like, there's enough volume on every one of these bars for every person to get their orders filled if they want to get their orders filled.
So
Like, it's not there's no reason to look at the volume.
it's
Yeah,
funny. So there's I'll tell you one. So GameStop. You ever looked at a 1 minute chart of GameStop? The first day it gapped up like 20%.
I haven't actually.
So I can't remember. I don't believe it gapped up 20%. I think it it opened like some small percentage, and then in the first basically 5 minutes of the bar. So minute one, if you look at the volume, let's say an average open of GameStop is like 100,000 shares. Minute one is at like 200,000 shares. Minute two is at 400,000 shares. By the third minute, you're up to like 800,000 shares. And then by the close of like the fourth minute, it's like over 1,000,000 shares. And that's when it went up like, I think 20% or 30% that, in the next like hour.
Mhm.
But it's fascinating because it's like, okay, obviously algorithms can spot this change in volume. But back to your point, yeah, what do I do with, there's some book I had on, someone gave it to me on a trading book way, way back, way before I even met Al. So this was like my second week of ever looking at a market. And it had to do with, it was volume price action, something like that. But it was reading volume on every bar. And it was what's interesting about that. The book was 30 pages, and so I think about owls. Owls is an average of 400 pages of just price action. But yeah, I mean, how do you really use everything you need to know is on the chart in front of you?
And I think that this brings up an interesting question, and so one of the things you said you don't like to look at volume or tick charts, and one of the reasons that I prefer time-based charts is because obviously you get your price, but time is a standard that traders all look at. And so
Exactly.
if you don't have something on your chart that is calibrated to the standards that all other things are calibrated to, then you're going to miss very important data points. Like for example, the owls data points, various data points about bar 18, the uh the bar 40 reversals, the time like on large gap open days, and there are some other kind of general market behavior, things that you want to be able to account for at specific times of the day. Like, if a trend is very strong, that is not going to usually test the EMA prior to one. If you're getting a substantial test of the EMA and a bar closing below the EMA on what looks like a strong trend day, typically it's going to be a lower trading range, upper trading range, or spike and horizontal channel. There's a variety of other expectations you can calibrate, but that's based on time. Like if you don't have time embedded on the bars that you're looking at, then my belief, and this comes back to the belief, is that you're at a disadvantage because you can't properly calibrate those expectations. And I think this comes back to that larger consideration of how you calibrate expectations based on the systems that you like to trade. And that's really a first principle for system design.
And you kind of took the words out of my mouth there. That's a belief I have, and you have to have those first principle beliefs, or those beliefs that you know to be true. And yeah, for me, tick charts. If I want to trade crude oil, what tick do I use? And then, sometimes if I take something on a 5-minute chart, maybe it's a strong enough move it's going to get a second leg. Maybe I can reduce the position, change it to a 15-minute chart, and then look at a different market. And that way I can swing trade something on a little bit of a higher time frame and look at this different market. But how do I go from what tick chart is that? So that's, to me, that's added variables to think about. And what James said, if I want to look at something, I want to look at the close of a 15-minute bar or the close of a 60-minute bar. That's easy to do. I just look at my clock and see what time it is. But if it's a volume chart or a tick chart,
You have no idea where it's going
sometimes
to close.
you don't know. It depends on the
Yeah.
volume.
Yeah.
And so I could not agree with you more on that. Someone asked a kind of interesting story, and I'm happy to say it. What was the riskiest trading decision you've ever made? Really, for me, I really equate that to what is some of the mistakes I've made. And fortunately, I made some of these mistakes many, many years ago, and therefore with not a lot of capital. But I have blown very, very small accounts in the past. And the way I did it was like everyone's done it. You buy, scale in, and let's say it's like $1,000, let's just say. But buy, scale in, and what ended up happening is over the course of weeks, you buy, scale in, get out, sell, scale in, get out. And James probably know where I'm going with this. You end up, I remember I don't remember what it was, some Forex market, but I bought, scaled in, except the market didn't bounce that time. It went lower. And I remember hanging on. I mean, I held on to the trade for, it was like 15 hours. It was basically overnight. Didn't go to bed. But the long story short, the greatest lesson I learned from that was you have to identify when you're getting a strong breakout, when something's trending, and you cannot go against a trend. So for me, one of my big rules is if there's a big breakout, I want to trade in the direction of the breakout, even if that means I'm flat. So as far as risky, that's as far as riskiest decisions, I'd really rather like to think of that as what are things I've learned.
Yeah,
Now, granted, the reason why I wanted to bring that up is there was no systems academy when this area was made. There was just Brad listening down in the trading room and watching the course and then trying to figure out what I'm doing. And, I wish back then I had someone explain to me, tap me on the shoulder and say, "Hey, do you understand what you're doing?" And I'd say, "Yeah." And then they'd say, "Well, do you really understand? Do you understand the math behind it? Do you understand exactly how you're getting in, exactly how you're getting out? What is the exact calibrated expectation, or what is your true hypothesis of what's going to happen here?" Because if I would have had that in the first place, I would have never made that mistake. And I'm glad I made the mistake. I'd much rather make that mistake now, or back then, and learn from it, than make it now or in the future. But system design can help you prevent certain mistakes because you account for it in designing it.
Yeah, I think for me the riskiest, and I would say I would rephrase this also to be most useful. Riskiest trading
Hmm.
decision. I mean, I could say like, buying the first pullback of the Bitcoin top in 2017, like that was a bad idea. And then holding it down to 3,000, that was, you know, painful. But beyond like an isolated event, I would say the worst or the riskiest is using market orders improperly, impulsively using market orders. I think that's the thing that, and for me, it's one of the things that I actually practice every day, is trading a full day with only limit orders, just to reinforce, the principle that there are at least 20 legitimate limit order trades every single day, and that there is no reason to feel any anxiety or rush to enter a trade. And for me, still the riskiest trading behavior, I wouldn't say decision, I'd say riskiest trading behavior is improperly using market orders.
Oh, absolutely. That's a good one. That's a really good one. And James is just improperly using market orders in the sense of I'm going to impulsively buy the top of something because it's going up, or I'm going to buy as something's going down.
Uh, Buying, so basically front running breakouts. So leaning into market structure and anticipating what you believe to be a breakout without, and so basically front running the breakout and follow through, and just taking on the breakout bar.
That's a
Um,
good one.
and and it's a perfectly legitimate way of trading, but if you're not prepared to exit very quickly, then it can get dangerous very quickly also.
Oh, 100%. And that's what happened to me. It worked for a split second, but I was not prepared. I knew I should get out, but I wasn't mentally prepared to get out.
Yeah, the one of the things that I've um, so if I've used a market order improperly, then I also cannot scale in. So that's another uh, rule.
Oh, absolutely. Yeah, you can just get out of the trade.
Yeah, yeah. There's no adding to try to get out break even, because
Mm.
it typically means that you've done something that is not aligned with what the market is actually doing, and so
And I
you're
want to say, and
imposing
one
yourself on the market rather than responding to what the market's doing.
100%. And one thing I would say with that is when you look at your trades, if you're a winner, if you end up basically having this big intro drawdown of the trade, so you're risking, let's say to make $100, you end up risking 150 or $200, and that seems to be a constant variable. You will get if you're taking high, well, you'll probably you will feel like you're taking high probability trades, because you make the $100, even though you had a deep drawdown, you'll make $100. And what will happen is it's going to give the illusion that you're going to win X amount of winners in a row. And then you're going to take a big hit on one or two of these trades where that did not work. The point is, it's really, really dangerous whenever your risk is greater than your reward. It's a very dangerous strategy. And what I'd really recommend, and you'll notice it by trading breakouts in the direction of the breakout, what you'll often notice is your actual risk is much smaller more often than if you were to fade the breakout. So a lot of traders, I've kind of grown to be this way more. Instead of just buying as the market's going down at a prior swing point, waiting for the market to go sideways at some point. So a lot of traders, I'll just share, James, you don't mind, I'm going to share just a very quick example of this.
Yeah.
Because I thought it was a really good one. It was on that day.
This is a great
I think
example.
it was the 28th that the individual mentioned. Yeah, right here.
Mm-hmm.
A lot of traders don't necessarily, it's a big bear bar, it's a pullback. A lot of traders are not really thrilled to buy below a big bear bar closing on its low. So what do? They wait for this. They wait for this doji, and then they buy below the bar. Now, why would they buy below the doji or when the market breaks below the doji? Because on a smaller time frame, you had a bear bar. A bear bar is a bear breakout. This doji is a trend line break. So you have a sell-off, trend line break, retest. So it's basically a double bottom on a smaller time frame. That's a lot easier to do. And then other traders would just rather wait for the market to actually sell off and then start to reverse up. But the real reason why I wanted to mention that is there are a lot of things that traders naturally do with market orders that are not as efficient than just waiting for, it's like buying the bottom of a trading range. You could buy the bottom on a limit order, but if the range is broad enough, you could probably just wait for, it's probably going to go sideways at best for a couple of bars. And buying as the market's falling is usually so you can get in and get out within a bar or two. It's not for, you're going to buy the low, hold for the market to go sideways, and then reverse up. Most traders, they wait for the market to go sideways and bottom, and then they buy. And so that's just something to think about. You always want your risk reward to be one. James, one thing I wanted to talk about is, an ideal candidate for Systems Academy. And someone's out there, they've watched the videos, they've watched us a time or two, and they're trying to think through, am I an ideal candidate? Am I not an ideal candidate? And one of the things I've had, there's been a couple of people I've talked with, and I've given them this challenge. They're kind of on the fence, and at the end of the day, we want, this is not about convincing people. We want people to see the reason why they should join. And I gave them this assignment, so I'm going to kind of offer the assignment to people listening. And the assignment was, these are people that have watched the Brooks trading course for some time. They're pretty familiar with trading. And the assignment I gave them was can they build their own system? Because really what you're thinking through is they know they need to build a system. They know that system design, it makes perfect sense. That's a lot easier than discretionary trading. So the task is, can you take a concept from Al's video course? Can you build a system on it? And how far can you get with it? And I would challenge everyone to try that. Whether it's a breakout system, whether you're looking to buy second entries, basically do exactly what Al says in the video course. Beginners should focus on 1 to 3 setups. Can you build that setup? And then how far down the path can you go with that?
Yeah, that's a good assignment. I was actually just pulling up something.
Sure.
Might be useful to take a look at. Yeah, so let me just delete a few of these. Okay, we're not going to look at this in depth, but just as an example, for
Share your screen.
a rudimentary first pass on the I1R system, because I've talked about this a number of times. I mean, this is system documentation for it. I mean, this is 30 pages. So I mean, with this is profit taking slide. These are protecting profits. So I mean, there's a lot of these are reentry rules, guidelines for initial stop loss. So the point is that when you go through and do your system design, I mean, I think a lot of people think that they have designed a system. They say, I trade high ones and high twos, or I trade high twos and low twos. Usually people say that. They don't usually say they trade high ones and low ones. So having a price action condition, call it a setup. It needs to be more than I trade high twos for it to even be a setup, actually. But you need to define what the signal bars.
What?
Right, and you need to define what the signal bar threshold is that you use for signal bars, and what the variations are on what those signal bars could look like, and how your entries would be different, and how your expectations would be different. I mean, there's like so many nuances to trading high twos that just saying I trade high twos is relatively meaningless, because there's too much variation for that to be a functional system. I mean, you could have a 30-page document on trading high twos, and so the idea that someone has a system it's a good starting point for someone to go and build a system based on the principles that Al teaches. But the one of the things that and this is something that Ali said to me when we started SA2 last year, these should be professional grade systems that you could go and raise money with, to go trade. I think this is the kind of document that you would say, I'm looking for some investors. This is the kind of approach that I'm going to take to the market. Here's the way I trade. Here's my track record. Let's go. And that's the difference between I built a system I trade using, trade on high twos, and the kind of systems that you would be producing in SA2.
So it brings the level of confidence in that system up tremendously. Yeah.
And the professionalism of the system. I think that there are things that most traders just don't account for when they think they're designing systems. And I mean, and to be fair, they are designing systems, but the robustness of them, and the depth of understanding, I think, is just not the same that you would get going through SA2. And to be fair, it is entirely possible to do this outside of SA2. I mean, Ali didn't have SA2, right? He taught himself to go through this iterative process by reading, 300 different books on system design, studying with different people, and producing this, as the derivative, the second order kind of refined product. So you 100%. Have so it's not a derivative. It is the refined product. So it is the milk into ghee, or the butter into ghee, and so when you have the refined product, it has all of those. It's kind of a weird metaphor, but they have the milk solids, right? The things in the butter taken out, and now you just have the refined product at the end, and that's really what SA2 is, right? It's taken all of the potential distractions, all of the things that could become part of your system design journey that you don't really need to develop a very, very high quality system, and just cut them. And so what Systems Academy does, and the way Ali designed it, is to focus on those highest value components, which are standardized, across all system design, and then use the coaching process to help the students move through the iterations of their system to really hold the student accountable for the process they're going through. And I think that's the unique value, is that it is a collaborative process. It's not just someone going out on their own and hoping that they're doing it right.
100%. And, I can definitely tell you that trying to build a system just on your own is very challenging. Trying to trade without a system on your own is very, very challenging. And the reason why I mentioned any of that is because in general, a lot of people, they start studying the video course and they think to themselves, okay, I'm going to study, and once I figure this out, take a couple of years, I'll figure it out, and smooth cruising, we're good. And that is just that's not how it works. That's not real. And if you really want to become, let's say you want to be a trader like Al, if you really want to get there, you've got to think about, okay, I want to be at the Michael Jordan level of basketball. I'm at this point, and I'm speaking about someone who's done, in terms of just time and experience, they're on the other side of all of this. To really trade at a discretionary level where you can just pick up the chart, trade how you're feeling, takes a tremendous amount of time. Even with that, if you listen to him all the time in the trading room, guess what he's focusing on? Guess what he's talking about during the day? He's talking about stop orders. He's not always taking the stop orders, but why would he talk about stop orders so much? Because the stop order can help guide him as to what side the bulls or the bears in terms of swing trading, who's winning. So even when you listen now, he has a mental system that he's built, and his experience allows him to kind of bend, the rules of his system and decide, do what he wants to do. Most people, that takes an extremely, very, very, very long time to get to. So what James is saying, I'm going to trade second entry buys. I'm going to trade a high 2 at the moving average in a bull trend. That's good. That's a starting point. But how do you define the leg count? How do you define the signal bar, as James said? How do you define the bull trend? There's so many factors. And that is something that you really have to think through all those.
I mean, especially when you're trading high 2s and trends, typically you have bad signal bars for the high 2. Like you don't have ideal signal bars because the market can easily reverse from weak signal bars, and typically does. So
absolutely,
I think this is a good leading into this last question in regards to these systems. Is the end goal to set up a version of an algo in which these systems are so in depth that the trades can be automated, or at least the signals are automated? That can be a goal for some people, but it's not the goal of the program.
James, can we touch on just for 1 second with this? When we think about coding, everyone naturally wants to go to automated trading. How difficult is automated trading really? I mean,
phenomenally difficult.
We have there's an individual. He's doing Systems Academy again this year. He was a phenomenal example of a student last year, and he would tell you the same thing. He has a system that's pretty much automated, and he also trades some of a manually traded system. But he would tell you he's very good with coding, but it has taken him. I think he just stayed in front of a computer like 16 hours a day. I don't know how long he spent. Travis.
He's also a medical doctor, so he is
a medical doctor. So his work ethic.
He's doing surgeries in his downtime. That's the way he rolls.
Yeah, I mean, surgeries are the easy thing for him.
Yeah.
So James, continue. I just wanted to make it clear. Automated's very difficult.
It's very difficult. I mean, I've not even tried to go down that route. I mean, I know what it would require, and I would much rather spend my time trading than going through all of that coding and back testing, and and also knowing that I can execute the system better than the algo, because one of the things that you see is generally even a very high SQN, and we can kind of get back to that SQN question. SQN is basically a measure of how reliable the system is, and so system quality number, as Brad said, and so the higher the number, the better. You can have a system that is upwards of 7 or 8, and you automate it, and it goes down to at best 2, usually between 1.5 and 2, and that is because
good.
2 would be a very, very, very high
That's
quality
impressive
automated
for an
system.
automated system.
I mean, most of the folks who have automated their systems in Systems Academy are around the 1.5 mark.
Yeah,
And
I would agree with that.
and that's that is an accomplishment. And so it's being okay with deeper and more extended drawdowns. It's being very, very trusting of your code and the systems that are running it. So to trade with any size, you have to have a lot of infrastructure supporting you. Ideally, people actually supporting you with that infrastructure. So there's a lot of hidden costs that people don't anticipate when they think about automated trading, just to make it reliable,
And,
practically.
and, and James, one thing, we don't have to say the person's name, but
Mhm.
you know what I'm talking about, where he has one that's about 1.5, but he he's he knows that if he could improve his discretionary trading and just trade it more of a manual standpoint, he can dramatically raise what the number is.
The SQN,
Because
yeah. He doesn't like the feeling of the 1.5.
it's slow.
Yeah, yeah, and so um, yeah, it's not the goal of the program. Some people have that as their personal goal, and that's one of the things they account for when they come into the program. The program is not designed to help students develop fully automated systems. Typically, those who are more comfortable coding will code the signal generator into their
Hmm.
systems of their systems, so that their charts will. And I'll share my screen real quick, so that their charts will get marked up, but they are not going to necessarily trade automatically. And so like here is the buy signal, this is the sell above, this is a buy on a pullback, and buy the close and buy on a pullback. This is a first pullback, so this is actually a sell, it's a breakout. This is a sell, this is a sell, this is a buy, and this is another buy. This is a sell above, and this is a sell above. Both of those failed, and we got an opposite signal. So, like, the signal generator is built into this, and this is the system that I was telling you is trading on a 1 to 2 bar trade. So, this is a sell above, this is sell above, this is sell the close, this is sell the close, and selling a pullback. That's sell above. This is buy below, and that failed. So you can reverse here or reverse here, but it's also getting late in the day. So again, if you didn't have time on your chart, things would get pretty difficult to discern once you get into this region here. But yeah, so this signal generator is built into the chart or built into the algo, and so that's more the direction that folks go, at least while they're in SA2. Some folks, after they've built their signal generator, will do the coding for a fully automated system, but that is a phenomenal amount of work and not something that we are, as coaches, we're not going to spend time, quality testing or going through, the trade management code. We can talk about the logic for trade management, but coding, trade management logic is very, very difficult.
And it'd be a disservice to that individual because it's a very long process. And most traders, if they can figure out the basics, leg counting, we've probably, I think combined, have said it 100 times. Trade the first leg for the second. So leg one, look for leg two. When you have leg two in a trading range, be careful about scaling in. Usually it's just better to get out below a bear bar if it's a bull bar. So if it's a rally and it's second leg, get out below bear bar closing on its low. Leg three, don't trade the third leg. If you can manually figure out how to do that and read it in a reasonable way, you're going to dramatically improve your system. But, and even coding a signal bar, that's a lot easier. It's easier to code a signal bar and manually trade it than it is to fully trade it or fully automate it.
Yeah, there's so many different things that come into play at that point. Actually, the Jay's question here might actually be a good question to end on for the day,
Yeah, that's what I was
because
thinking too.
Um, yeah, I think that there are many of us who have felt like losing hope at different points where things just don't seem to click and don't seem to work. And I think that there are a variety of reasons why that can happen. Um, but as far as a source of information, I don't see anything higher quality than BPA and Al's books as a starting point. I think that Ali's PTM, once you've fully digested all of Al's information and just gone through it slowly enough so that you've really spent the time with it. Um, as a corollary, I mean the live trading room that Brad's in, some of the older videos that you can buy of just Al when he was doing the room by himself. I mean, those are all phenomenal resources and relatively low cost. I mean it is low cost. I mean, what am I saying? It's like you can get years worth of study material for less than the cost of a quarter of one community college class.
In the trading room, James, I've probably got if I looked up Dropbox, I've probably got 600 or 700, maybe 800 just recordings of Al. And I've been saying
That's pure
I'm going
gold.
to go back and watch them, but I still haven't yet. And I've listened to some of them, but I mean, just like actually, start cracking them open and stuff. But it's like I still got to get back to Al's books, and then it's like I still want to look at the video course and look at its encyclopedia. There's so much. One thing I wanted to touch on with this topic, and I was telling someone this last week, a week or two ago. One of the challenges that you're facing now is Al has a plethora of information. The challenge is you've got all of these chats, you've got the Discord, you've got these telegrams, and I'm a firm believer that it's great to communicate with people, but when you're really learning and studying something, it can do you a disservice to start asking too many questions of what's a high two or what's a high one. In other words, really thinking through what it is. When I think back to when I was really studying Al, I go back to 2013, 2014. The Brooks Trading course didn't even have a forum page. There was no Telegram. There was no Discord. There was the BPA, the Brooks Price Action website that occasionally people would comment on, but really there wasn't a fast-paced communication. So you were just kind of stuck with reading the books and watching the videos. And if you knew of somebody that was studying the course with you, you could talk to them. I think a lot of people don't spend enough time thinking, is where I'm getting at. They don't spend enough time saying, for me, I, just like everybody, when I was listening to Al in the trading room, it took me a while to really trust Al. And the way I started trusting Al it wasn't because someone told me, oh, Al's this really good trader. He's this, he's that. It wasn't any of that. The way I realized it was there was some period of time I was listening to Al long enough where I would say, hey, what he's saying makes complete sense. He'd be talking about this bar and it would go up. And then when I'd go to the recording and listen to what Al said, he was talking about such a just minor piece of information that was telling just this whole story. And it made me realize of course he knows what he's talking about. And one thing I want to touch on, the reason why I wanted to bring that up in the first place is you have all this information, you have to make it your own. For me, what helped me a lot was taking Al's information. I had to convince myself that the information was true and valid. Then I started watching Al and I started assuming everything Al said was true. And it had probably been a lot faster to just focus on major trend reversals, but you have to start with that information. So,
I mean, to that point, I think so. It's a great example of a famous organ player called Jimmy Smith. He was not an organ player, but when he decided that he wanted to, take his jazz organ playing, more seriously, he was in a funk. He rented a warehouse and just played organ for I forget how many hours a day. I think it was like between like 12 and 14 hours a day for a few years by himself in a warehouse. And then he came out and he ended up being one of the most famous jazz organ players, who's ever played the jazz organ. So I mean, the idea of like not needing exposure to all of this input is actually a really, really good point, Brad. And I think that it forces
Lock yourself in
the
the room and look at it.
yeah, and I think, well, I would say with a printed copy of Ali's How to Become a Professional Price Action Trader, because that's the map, that's how to do it, and you have the materials with all of Al's work, with his books and all the BPA, and you take the map that Ali gives you with the how to become a professional price action trader, and then just if you follow that line by line, you're going to be good. Like I have full confidence that you will do well. And I think that
100%.
the problem is that it is such a process, and there are many steps in Ali's account of how to become a professional price action trader. So
There couldn't have said it better myself. I really couldn't. So this has been about an hour and a half, give or take. We will do more live streams. If you want to learn more about Systems Academy, there's some links below in the video. You can click around and see what you find.
and we'll practice.
With that,
We'll practice keeping these shorter too. We don't.
we will. We'll get
we
there.
don't-
One day
yeah,
we'll get there.
Yeah.
All right, everybody. Thanks for listening and take care.
Have a great night.